Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Fact: some companies are taxed differently simply because of who controls them. A close company is a company that is controlled by a small number of people. Control usually rests with shareholders together with their associates, such as close family members. When deciding whether a company is close, voting rights, share ownership, and entitlement to assets on a winding up are all taken into account. Most owner-managed businesses and family companies are close companies, even where they trade normally and fully comply with tax law. Close company rules exist because companies under personal control can be used to extract value in ways that are not available to widely owned companies. For example, profits may be taken out as loans rather than dividends, benefits may be provided instead of salary, or tax may be delayed through connected party arrangements. The close company rules are designed to prevent income being shifted, disguised, or deferred through personal control. Some close companies are classified as close investment holding companies. These companies exist mainly to hold investments rather than to carry on a trading activity. A close investment holding company pays corporation tax at the main rate and cannot benefit from the small profits rate or marginal relief. This prevents investment income from being sheltered inside closely controlled corporate structures. One of the most significant close company rules applies where a loan or advance is made to a participator. Participators include shareholders and others with a financial interest in the company. Where a close company makes a loan to a participator, a separate corporation tax charge arises at 33.75% of the loan amount, as at September 2025. This charge exists to discourage profits being extracted as loans instead of taxable income. If the loan is repaid or written off, the company may be able to reclaim the tax charge. However, anti-avoidance rules apply. If a loan is repaid shortly before the end of an accounting period, and a similar loan is made shortly afterwards, the repayment may be ignored for tax purposes. This prevents temporary repayments being used to avoid the charge. Close companies are also subject to special rules where benefits are provided to participators. Where benefits are not already taxed as employment income, they may be treated as distributions. Additional anti-avoidance rules apply where benefits form part of arrangements designed to reduce tax.
Where a close company owes interest to a participator, corporation tax relief may be delayed.
Relief is generally only available when the interest is actually paid, not when it is accrued. This prevents profits being reduced by unpaid interest owed to connected individuals. Anti-avoidance rules also apply where a non-UK company would be close if it were UK resident. In certain circumstances, income or gains of the company may be attributed to UK participators. These rules prevent profits being parked offshore while remaining under personal control. Close companies are also subject to special inheritance tax rules. Transfers of value by close companies can give rise to inheritance tax charges on participators, and related rules apply where assets are transferred abroad. The transactions in securities rules apply only to close companies. These rules counter arrangements that convert what would otherwise be income into capital, particularly on company sales and liquidations. From the 2025/26 tax year, directors of close companies must report additional information on their self-assessment returns. This includes confirmation that the company is close, dividend income received, the director's highest percentage shareholding during the year, and the company's name and registration number. Only the director's own shareholding is reported, not those of associates. And this brings us back to the fact we opened with. Some companies are taxed differently simply because of who controls them. Close company rules exist to stop closely controlled businesses being used to extract value or shift income in ways that public companies cannot. Why did the tax inspector bring a ladder? To look for higher profits. This content is for general educational purposes only. Tax rules can change. Always check current HMRC guidance.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.